What's the basis for my thinking that the recession really is baked in the cake? Why do I think it's baked in the cake, and why have I thought that for some time? I've thought that because the course of the economy, nominal GDP, that's real GDP plus the inflation rate, is determined by what's been happening to the money supply a year and a half or maybe even 2 years ago. And what have we had? We've had, since March of 2022, the money supply has actually contracted by 4.5% since then. Now, that's not unprecedented, but it's pretty close to being unprecedented. We've only had 4 times since the Federal Reserve was established in 1913 that we actually have had contractions in the money supply, measured broadly by M2. And of course, the biggest one was 1929, 1933. You know what happened then? We had a Great Depression. And the other 3 contractions we have to go back into the 1940s, 1947, 48. That was one. We had a recession. And then we had 37, 38. That was a recession. Then we had the big one with the Great Depression. We had one other contraction in the 20s. And those all were followed by, with a lag, recessions. So when you get a contraction, you pretty much know the thing is baked in the cake. That is, the R word is baked in the cake. So that's where we're going in 2024. As I said again, the money supply, which the Fed doesn't pay any attention to, and most analysts, by the way, don't even look at the money supply either. This is literally like flying an airplane with an altimeter that has nothing on it. The transmission mechanism works like this. The money supply goes up. And what happens? The money supply goes up, and David Lynn and Steve Hanke have more cash balances as a result of that in their bank account than they would prefer to have. And so what do? They start spending the excess cash balance that they build up and bringing it down to a normal level. So yes, consumption happens, but that's in the transmission mechanism. What causes that? The cause of it is the excess cash balance that's been built up due to the fact that the money supply has gone up in the first place. So you have to go back always to the original source of all these things. So first, let's get the transmission mechanism down. The money supply goes up. The next thing that goes up, due to the fact that these cash balances are in excess, asset prices go up. So what's that mean? That means the stock market goes up, real estate prices go up. Then the next thing that goes up, another lag, is the real economy starts revving up because of this. And then the last thing that actually happens is price changes. That inflation, by the way, is usually the end of the line in the transmission, and that can take up to 18 months or maybe even a little bit longer before the inflation starts showing up with headline inflation numbers changing. So you have to look at what causes all these things in the transmission mechanism to start flipping up or flipping down. We will adjust our cash balances to preferred normal levels. And if those cash balances are excessive because there's been an excessive increase in the money supply, we will trim those down, and we'll be consuming a lot. Let's go back to the payroll data, though. So remember, we started with the payroll numbers. They came in very strong today. The payroll increases 216,000 jobs. The consensus was only 175,000. So that was better than the consensus. And the unemployment rate stayed at 3.7%. As you said, the consensus was, they thought it would go up to 3.8. So all of that was good. You would conclude, well, this looks very strong. So how can Hanke be talking about a coming recession when you have this very strong labor market data coming in? Well, if you look under the hood a little bit, that data, it isn't really as strong as it appears to be on first glance. For example, the last 2 months, they've actually made downward revisions in the jobs added by 71,000. So all of these revisions, they come out with a new number for the payroll growth, but then they revise down the last payrolls. So we've had downward revisions going on in payrolls. We've also seen the 11th consecutive month where temporary help has gone down. So that indicates things aren't quite as tight as you think, because they're not scrambling around trying to hire temporary help. Actually, for 11 months in a row, the temporary help has gone down. Also, you've got a slight fall in the monthly aggregate hours worked. You've also had a drop in the household employment over the last 3 months. And if we exclude government and healthcare workers and leisure and hospitality workers, actually the employment is way below trend. The hospitality industry has been pretty hot in the healthcare, that sector, healthcare and hospitality, and government employment. So they've been adding a lot of the payroll ads have been government employees, which from a productivity point of view, that's a big negative, actually. That's kind of a bad sign. The other thing to watch is the hours worked. There's been a weakness in that, along with the temporary help thing. So if you look carefully at the thing, it looks pretty good on the headline, but under the hood, there's a lot of weakness showing up. So this is, by the way, typically what you get as you go into a recession. Okay. Remember, we've talked about this before, and the last thing that people want to do is lay off permanent workers. So, and that's been happening. Here's what's been going on. Last year, people who were businesses in general and CFOs in general, they were pretty gloomy. They thought we were going to have a recession, but they didn't fire people, because you don't fire people until you actually get in the recession. And now what do those business people think? Contrary to me, that now most businesses think we're going to have a soft landing and we're not going to have a recession. So all of those factors, the fact that you don't want to fire somebody before the recession, and the fact that businesses are now more optimistic and they think the probability of recession become a lot lower, those two factors mean you don't want to be firing. You might be wanting to cut back on the hours a little bit, which they're doing, but you don't want to be firing. So that's why we see, payroll growth has actually been pretty good. It was beat the consensus, because why? Businesses are saying, I think these forecasts by people like Hanke that we're going to have a recession is a lot of bunk. And we're not going to have a recession. We're going to have a soft landing. I'm not going to fire people. I'm actually going to hire a few people. They're not using the R word, and I've never gone that far, but they're saying things are going to slow down. Now, why do they say? I say it's because the money supply has been contracting at an unprecedented rate that we really haven't seen since 1929, 1933. That's how far you have to go back to see something contracting as it's been contracting since March of 2022. Now, what are they looking at? They're looking at current data, and they are looking at things like the yield on the 10-year bond. And the yield on the 10-year bond had gone up, and they say, that indicates credit conditions are tightening up because the interest rate, not the money supply, the interest rate has gone up. The markets are tightening things up for us. In other words, they're not even saying we tighten things up. They're saying the market is tightening. So they're forecasting models, by the way, which are no good. The forecasting models of the Fed have had a terrible record. They've usually been way off because they aren't looking at the money supply. They're looking at all these other things going on. What's going on with credit spreads? What's going on with the 10-year yield? And so forth. One thing, by the way, they also they do look at the shape of the yield curve, and the yield curve's been negative, and that's always a good indicator for a coming recession. A negative yield curve in which the short-term rates are higher than the long-term rates. We've had one for quite some time now, which happens to be consistent with this contracting money supply, by the way. But remember, interest rates are not a good indicator of monetary policy. Changes in the money supply are an indicator of the tenor of the monetary policy that we face. Gold usually does relatively well during recessions. And look at the 10-year bond. All interest rates are determined by where inflation is going. That dominates. There's been a lot of talk recently. They say, oh, the bond prices are going to be going down and the interest rates are going to go up because the Fed has so much debt that has to roll over and finance. If the supply goes up and the demand stays the same, what happens? The price goes down, and if the price of a bond goes down, the interest rate goes up. Well, that sounds okay, but what dominates? And John Greenwood's been looking into this in great detail, my colleague John Greenwood, as you know. And what happens is, in fact, not consistent with that story. What happens with interest rates is that they follow inflation. If inflation goes up, interest rates go up. If inflation goes down, interest rates go down. And what's going to happen next year? Remember, using this quantity theory of money, Greenwood and I said that, number one, we said inflation would go up, remember, to 9%. It went up to what? It went up to 9.1%. So we got that right on the upside. Now with a contraction, we said by the end of this year, by the end of actually last year, we're in 2024 as we speak, but at the end, the December number hasn't come out for December 2023 for inflation, but we said that it would come in between 2 and 5%. The November number is 3.1%, so it's pretty clear we're going to hit the bullseye again. It will come in for 2023 somewhere between 2 and 5%. That's our forecast. Where do we think it's going in 2024, this recession year? We think inflation will end 2024 below, headline inflation below 2%. What's that mean? It means that interest rates are going to be coming down. So it means that being in long bonds for 2024 would be okay.